Last week, there were over 115 put contracts sitting at the 675 strike on SPY going into Tuesday's expiration. When that much positioning build up at one level, price doesn't move randomly anymore. It starts to revolve around that strike. And that's exactly why we talked about 675 as the battlefield level in last week's breakdown. Now the question is, where is the battlefield for the coming week? In today's breakdown, we'll start with a quick recap of last week's setups, including how some of those levels played out. Then we'll go through a full SPY options chain analysis day by day, with a special focus on Friday's expiration. And finally, we'll look at 4 new setups to watch for the coming week. Let's get into it. Before we move into this week's SPY option setup, let's take a quick look at how some of the levels we discussed last week actually played out. Because one of the main ideas behind this channel is simple. When positioning builds up at certain levels, price often reacts around those levels. In last week's breakdown, we talked about geopolitical tensions in the Middle East and the potential impact on oil prices. We looked specifically at the USO ETF and the call walls sitting at 83, 85, 90, and 100 for the March expiration. As soon as USO broke through the first call wall around 83 to 85, price quickly moved into a positive gamma environment. From there, the path higher was relatively clear because there were very few put walls above those levels. By the end of the week, USO closed around 108, breaking through those major call walls almost one by one. We also look at Lockheed Martin given the geopolitical backdrop. The key levels we discussed were the call walls at 650, 675, and 710. Lockheed actually opened the week around 717, breaking through the major monthly call wall at 710. And throughout the week, price repeatedly reacted around the 675 level, moving above and below it several times before finishing the session around 672, with after hours trading near 676. Another name we discussed last week was SNDK. In the weekly expiration, we identified 2 major put walls at 550 and 540. Those were the key positioning levels to watch. During Friday, price actually broke through both of those put walls, which often signals that downside momentum is beginning to accelerate. By the end of the week, SNDK closed around 527, well below those positioning levels. And when major put walls get taken out like that, it usually tells us that market is moving through the existing positioning structure, which is exactly why those levels were so important to monitor. Micron was another interesting setup. We talked about the 375 to 380 zone as a key area of positioning. Once price broke below that major put wall around 375, the stock quickly moved lower and finished the week around 367. Looking ahead, the next significant put concentrations are sitting at 350 and 330, which could become important levels going forward. And of course, the most important setup last week was the 675 level of SPY. Going into Tuesday's expiration, there were over 115 put contracts sitting at that strike. Price briefly flashed below that level to around 670, but then moved back above it. Exactly the type of reaction we often see when positioning becomes heavily concentrated around the strike. So with that context in mind, let's move into the SPY option chain for the coming week. We'll go through the positioning day by day and see where the next potential battlefield level may be building. Now let's move to the SPY option chain for the coming week. SPY closed last week around 672, which already puts price right inside the range of some major positioning levels. Starting with Monday's expiration, the put positioning is relatively light. We're seeing small clusters of open interest around 670, 665, and 660, each with roughly 6,000 to 7,000 contracts. Not particularly large positioning, but they do start to outline the downside structure. Moving into Tuesday's expiration, the pattern looks very similar. Again, we see moderated put positioning around 670, 665, and 660, each with under 5,000 contracts. So nothing major there, but it does reinforce that same downside hallway. On Wednesday, we see another small cluster forming around the 672 strike, again, around 6,000 contracts. So the early part of the week is defined more by smaller positioning pockets rather than one dominant level. Thursday is where things get a little more interesting. We actually have both a call wall and a put wall sitting at 680 strikes, each with around 5,000 contracts. So if price moves toward that level, it could act as a temporary pivot point. But the most important position is clearly sitting in Friday's expiration. Here, we see two major put walls. The first one is at 675 with roughly 70,000 contracts of open interest. And the second major level sits at 660 with about 62,000 put contracts. What makes this interesting is that SPY is already trading below 675, which means that level is effectively already in the money. So the next major positioning level below the market is now 660. And when large concentration of open interest sit at levels like this, price often gravitates toward them as expiration approaches. So the key question for this week becomes, does SPY continue drifting lower toward that 660 positioning level? We'll keep that in mind as we move into the individual setups for the week. Let's start the watch list this week with Micron. We actually talked about Micron in last week's breakdown, and the positioning there is becoming more interesting as price moves closer to some of the major option levels. Micron finished the week around 370. And if we look at the monthly expiration, we can clearly see two major put walls sitting at 350 and 330. Those are significant concentrations of open interest, which means they can act as potential magnets for price if momentum continues to the downside. Now, if we zoom in on the weekly expiration, we see very similar structure. There are also major put walls sitting at 350 and 340, which lines up closely with the positioning we're seeing in the monthly chain. So what this tells us is that 350 becomes the first major level to watch. If Micron continues drifting lower and breaks 350 with momentum, there's a strong probability that price could accelerate toward the next major positioning level around 330. So for now, 350 becomes the initial magnet level. And if that level breaks, the next area of interest quickly becomes 330. The second name on the watch list this week is GLD, the ETF that tracks the price of gold. GLD is currently trading around 473, and when we look at the option chain for the near-term expirations, we can see a series of gradual put walls forming below price. Starting with Monday's expiration, we see put positioning building at 472, 470, 462, and 455, creating a step-down structure to the downside. But the most significant put wall for the weekly positioning sits at 450, with roughly 2,800 contracts of open interest. Not an enormous number, but it's still the largest downside concentration for the near-term expirations. Now, when we zoom out to the monthly expiration on the March 20th, the option positioning becomes much more balanced. We see open interest building on both the call side and the put side, which often suggests the market could gravitate toward the max pain level as expiration approaches. Right now, that max pain level is sitting around 440. So if we connect the short-term positioning with the monthly structure, the path of least resistance could be a gradual move lower toward 450. And if price stabilizes around that level, we could potentially see continuation toward the 440 max pain area as we move closer to the monthly expiration. So for GLD this week, 450 becomes the first key level to watch, with 440 acting as the broader positioning target into the monthly expiration. The next name on the watch list this week is Robinhood. This is an interesting setup because it combines option positioning with technical structure. Robinhood is currently trading around $77. If we look at the option chain for the weekly expiration, we can see a gradual buildup of core positioning above price. There are core walls forming around 80, 85, 88, and 90, each with roughly 2,500 to 5,000 contracts of open interest. Not extremely large positioning, but they do create a step-up structure to the upside. Now, if we zoom out to the monthly expiration, the picture becomes even more interesting. We see major core walls at 80, 85, and 90, with open interest ranging between 11,000 to 15,000 contracts. So both the weekly and the monthly positioning point toward a similar upside corridor. Technically, the stock is currently sitting around the 61.8 Fibonacci retracement level, which often acts as an important support zone. If price holds this level and momentum begins to shift higher, the next major technical level sits closer to $93, which corresponds with the 50% Fibonacci retracement level. And when we combine that with the core positioning between 80 and 90, it creates a potential short-term upside setup. So Robinhood becomes another name to watch this week, particularly if price begins to move back toward the $80 level. The final name on the watch list this week is Tesla. Tesla is currently trading around $397. And the option structure this week is interesting because the stock has 3 weekly expirations, Monday, Wednesday, and Friday. Looking first at the Monday expiration, we see a put wall sitting at 400, which is already slightly in the money. Below that, there are smaller clusters of put positioning around 390, 385, and 380. On the upside, the nearest visible core wall sits around 405. So early in the week, Tesla could realistically move in either direction depending on momentum. But when we look at the Friday expiration, one level clearly stands out. There is a major core wall sitting at 410 strike with roughly 8,000 contracts of open interest. When a large concentration of calls sits above price like this, that strike often becomes an important level for the market to test or interact with as the week develops. So at some point during the week, there is a reasonable probability that Tesla could push toward that 410 level. One possible scenario is that price briefly sweeps below recent lows around 385 before reversing higher. Another possibility is that momentum shifts earlier in the week and price begins moving toward 410 more directly. Either way, 410 becomes the key level to watch for Tesla this week, especially as we move closer to Friday's expiration. So before we wrap up, let's zoom out for a moment and look at the bigger picture. One thing that becomes very clear last week is that option positioning continues to give us a measurable edge in understanding how price may react around certain levels. Whether it was oil through USO, the levels we discussed in Lockheed Martin, the move in SNDK, or the positioning we highlighted on SPY, the options chain once again helped us identify where the important battles in the market were taking place. Now, if we zoom out and look at the monthly SPY expiration on March 20th, we are dealing with a very large expiration, almost 3.3 million option contracts. And what immediately stands out is the massive put positioning sitting at 660 and 650. Each of those strikes holds roughly 110,000 to 120,000 put contracts. Levels like that often becomes major battlegrounds for price as expiration approaches. So in the short term, it's entirely possible that price continues interacting with those put walls as the market moves toward the March expiration. But when we shift our focus to the April monthly expiration, the position actually looks very different. At many of the same strikes that were heavily loaded with puts in March, levels like 680, 675, 660, 665, and 660, the April positioning is currently much lighter. In other words, the market is far less hedged at those levels for April. And when hedging becomes lighter, price can sometimes move more freely once the heavy positioning from the pre-expiration clears. So once we move past the March expiration, the structure going into April could allow for large price movement in either direction. Which again brings us back to the core idea of this channel. Positioning first, price second. Let the levels develop. Let the positioning tell you where the next magnet might be. But this is exactly why we focus on positioning first, price second. Because when a major call wall or put wall breaks, we already know where the next magnet level is likely to sit. And remember, the second mouse get the cheese. Let the first mouse get caught in the trap. Be patient. Let the levels develop. Let the positioning tell you where the market wants to go. And one more quick thing before we finish. Once this channel reaches 1,000 subscribers, I'll start doing live trading sessions here on YouTube so we can walk through those positioning setups together in real time. Until then, stay patient, stay disciplined, and remember, positioning first, price second.